Well, one thing I would just like to say is this tech hardware and equipment space where this stock resides, I mean, this was never the big problem in tech for us. We actually thought it wasn't that crowded. We actually thought it wasn't that expensive relative to other parts of tech. I'll tell you what really worries me now, after having watched all these dominoes fall, the software and IT services space, which I think has much bigger crowding problems at the individual stock level, at the broader industry level, much more severe valuation problems. That's the thing we should be talking about, the domino that probably hasn't fallen yet.
How do you define crowding, though? I mean, there's a limited number of shares that are out there. Funds own them. I mean, I don't get the crowding concept. And hedge funds actually cut back their tech exposure far in advance of the market declines.
Well, we look at it in a few different ways. Generally, we define crowding as take your community of people who pick stocks, whether that's hedge funds, long onlys, growth, hedge funds. You know, we actually track one basket of crowded hedge fund longs. A lot of these tech stocks are on it. They've been underperforming since the middle of the year as people have been de-risking. These tech stocks are the things that people are selling as they're wanting to get out of the U.S., as they're pulling some of that stock risk off the table. So, you know, I agree with you. Every stock is
the larger
owned,
percentage of shareholders in any of these companies are active managers, long-only managers, and retail. They dominate the holdings of any of these stocks, and passive.
Let me ask you, Lori. I mean, are you standing by 2890 S&P end of year?
We think it's still achievable, and so it's about 6% from where we were on Friday. And we've actually said, if you look at positioning for the broad market generally, we think we're at a bit of a crossroads right now. I don't think, I think stocks had generally gotten very crowded at the end of September. If you look at the futures data, we've come back down. We're below the May 2018 lows. So I think if we get the news flow cooperating, if we can get past this midterm election, I think we can get there.
But how do you get there without technology? I keep everyone, everyone just keeps dismissing, Stephen, you're saying the market's not that far off the line. If technology, if Apple, if these FANG names are not going to participate, you're not going to get the S&P going back to 2,900.
You can if you get other big sectors to work. And so look at a sector like financials. And what I think has really been interesting about this route that we've seen in tech and this route that we've seen in the market, on the good days in the market, you are seeing that sector rotation. You're seeing financials pick up. The bad days when defensives are leading have outnumbered those better days recently. But if you can get, sort of faith in that financials trade again, if you can get healthcare working again.
But healthcare is the second best performing sector year to date. But it's not like it hasn't been working.
But it's still cheap, and it's not overowned by the stock picking community.